You checked your credit score last week. Maybe it was 740, maybe it was 780. And for a second, just a second, you felt like you were doing something right, like you finally had proof that you were responsible with money. And then you looked at your bank account, and the number there told a completely different story. That's the part nobody prepares you for. You did everything they told you to do. You paid on time, you kept your utilization low, you didn't close old accounts, you played by every single rule. And your reward? A 3-digit number that gets you approved for more debt while your actual wealth barely moves. That quiet frustration, that sense that something doesn't add up, that's exactly what this video is about. My name is Alex, and I break down how the credit score system actually plays out for people dealing with the painful gap between looking financially responsible and actually building financial security.
All right, let's make this real. Let's talk about your actual numbers. You're earning $83,000 a year. That's meaningfully above the U.S. median household income. You're doing better than most. You've got a credit score of 760. Excellent range. Lenders love you. You've been told repeatedly that your credit is great. Now let's look at what your financial life actually looks like. $83,000 gross income. After federal income tax, state tax, and FICA, you're taking home roughly $61,000 a year. That's about $5,080 per month. That's the real number. That's what you actually work with. Now the expenses start. The national median rent for a one-bedroom apartment in 2024 is approximately $1,500 per month. In many mid-sized cities, it's $1,700 to $1,900. Let's use $1,600 because that's a fair middle number. Car payment. Because your credit score is excellent, you qualified for a 2021 used car at a 6.5% interest rate. Monthly payment comes out to about $420. And here's where it gets uncomfortable. You didn't feel bad about this payment. Your credit score made it feel earned, like you deserved the access. Car insurance, $140 per month. That's actually below the national average, which sits around $167. Utilities, phone, internet, $280 combined. Groceries, $350 per month. Minimum credit card payment, $85. This is on a card with a $4,000 balance you've been slowly carrying. Not a disaster, just always there. Student loan payment, $310 per month on a $28,000 balance. That's your IBR adjusted payment. Let's add that up. Rent, $1,600. Car, $420. Insurance, $140. Utilities and phone, $280. Groceries, $350. Minimum credit card, $85. Student loan, $310. Total fixed and semi-fixed expenses is $3,185 per month. That leaves $1,895 per month before gas, dining out, clothing, any medical expenses, subscriptions, emergencies, anything. After real life happens, let's say $400 in gas and miscellaneous, $150 in subscriptions and entertainment, you're looking at maybe $1,345 left over each month. And nobody tells you this part. That $1,345 has to cover your emergency fund, your retirement contributions, any savings goal you have, and anything unexpected that month. Financial advisors will tell you to save 15% for retirement alone. That's $1,037 a month at your income. Suddenly, that cushion looks a lot thinner. But nobody really talks about this part. Your 760 didn't make rent cheaper. It didn't reduce your loan balance. It didn't give you more take-home pay. What it did was make you an attractive borrower, which means lenders were actively, happily, enthusiastically willing to extend you more credit at any moment. And when an emergency hit, a $900 car repair, you put it on the credit card because you could, because the limit was there, because your score said yes. Now the balance is $4,900. The minimum payment goes up slightly. The monthly cash flow gets a little tighter, and the credit score barely moved. The math doesn't lie. A high credit score doesn't fix a tight budget. It just makes the tight budget look more respectable from the outside. Here's what the credit score system was actually designed to measure. It was not designed to measure your wealth. It was not designed to measure your financial health. It was not designed to tell you or anyone how financially stable or free you are. It was designed to measure one thing only: how likely you are to repay borrowed money. That's it. That's the whole thing. The FICO score, which most lenders use, was developed in 1989 by Fair Isaac Corporation. The scoring model rewards you for borrowing, paying back, borrowing again, keeping accounts open, maintaining low utilization, and then borrowing some more. The entire architecture of the score assumes that credit usage is normal, healthy, and ongoing. And this is where things quietly change. When you were young, you were taught that a good credit score was a sign of financial responsibility. But the actual behavior the score rewards is more nuanced than that. You get points for having multiple types of debt. You get points for keeping credit cards open even if you don't use them. Your score can actually drop if you pay off a loan and close it because you've reduced your credit mix. The score is not measuring freedom. It's measuring how well you participate in a debt-based system. Now, this isn't a conspiracy. The system isn't evil. Credit has real uses. Getting a mortgage at a lower rate because of a high score can genuinely save you tens of thousands of dollars over the life of a loan. That's real. That matters. But the way the credit score has been culturally positioned as a report card for your financial life, that framing is doing serious damage to how people understand their own financial situation. Because when your score is high, you feel like you're winning, even when you're not building wealth, even when you have $600 in savings, even when every month feels like a stretch. The score creates a perception of financial competence that can mask real financial fragility. And here's the piece that doesn't get said out loud enough. The marketing around credit scores is funded in large part by the lending industry. The people who benefit most from you believing that a high score equals financial success are the same people who profit when you borrow more money. Your 760 is their invitation. This isn't your fault. You were given a metric and told it mattered, and in certain ways it does. But you were never clearly told what it doesn't measure. And that gap between what the score captures and what your financial life actually feels like is where a lot of quiet financial anxiety lives.
Here's what's actually happening in your head when your credit score is high, but your bank account feels empty. There's a psychological phenomenon called identity-based financial confidence. When you have a metric that tells you you're doing well, it creates a cognitive buffer. It makes it harder to see or act on the real problems underneath. You've been told the score matters. You worked to build it. Now the score is good, which means some part of your brain files the folder labeled Money under Handled, even when the actual numbers say otherwise. This is not a character flaw. This is how human cognition works. We are meaning-making creatures. We look for signals that tell us we're okay, and when we find one, we hold on to it. But here's where it gets uncomfortable. That same psychological buffer can delay real action. When someone with a 620 score feels financial stress, the discomfort is obvious and immediate. They can't ignore it. But when someone with a 760 score feels financial stress, there's a cognitive dissonance because the score says they're doing fine, so the stress gets internalized as a personal failure rather than a systemic reality. I have great credit. I should feel more secure. What's wrong with me? Nothing is wrong with you. There's also the access effect. A high score gives you access to more credit, which can psychologically feel like having more money. It doesn't work that way, but the feeling is real. A $10,000 credit line feels like a safety net, even when it isn't, because using it doesn't make you safer. It just moves the stress into the future with interest. And then there's the social comparison. You see someone drive a newer car, live in a nicer apartment, take better vacations. You don't know their financial reality. You only see their consumption. And if your credit score is high and your consumption looks similar, you can start to feel like you're keeping up without ever examining whether keeping up is actually possible on your income.
Lifestyle inflation is quiet. It doesn't announce itself. It creeps in through small upgrades that feel justified by access. The credit card with points, the car you could technically afford, the apartment that stretched the budget but only a little. Each individual decision made sense. Collectively, they created a life that looks financially stable and feels financially fragile.
The shift worth making isn't about closing your credit cards or becoming obsessed with a different set of numbers. It's about understanding what the score actually measures and what it doesn't, so you can stop using it as emotional evidence of your financial health. Your net worth is a more honest number than your credit score. Net worth is simply what you own minus what you owe. It doesn't care how you look to lenders. It just reflects where you actually are. And for a lot of people with excellent credit, that number is much smaller than expected, or it's negative. That's not a moral failure. That's a starting point. The other shift is around what you're optimizing for. If you've been unconsciously optimizing for access, for approval, for higher limits, for better rates, you've been playing a game that rewards borrowing. Nothing wrong with that when debt is strategic, but it becomes quietly damaging when access starts to feel like progress. Progress in building wealth looks different. It's slower, it's less visible. Nobody gives you a score for it. But it's the thing that actually creates the sense of security that a credit score can only simulate.
If you take one thing from this, let it be this. Your credit score is a tool, not a report card. It measures one specific thing, and it doesn't measure your financial well-being, your savings rate, your actual security, or your future. You are not behind because your score is high but your savings are low. That's a normal outcome of a system that rewards borrowing. The awareness itself, recognizing what the metric does and doesn't capture, is the first honest step. Start by knowing your actual net worth. Write down what you own. Write down what you owe. The number you get is more truthful than any score. It might be uncomfortable, but it's real, and real is always more useful than impressive. If this video gave you a different way to look at your own financial situation, I'd really appreciate it if you hit the like button. It genuinely helps this channel reach more people who need to hear this. If you want more honest conversations about how money actually feels, not just how it looks, subscribe. I drop new videos regularly. And if something here hit close to home, leave a comment. Tell me where you are. I read them. You're not alone in this.